Right now, if you open your brokerage app and look at the screen, while silver appears to trade at $73 in the United States, the real price tells a very different story across the globe. In Tokyo, Japan, silver is changing hands on the street for nearly $130 an ounce. In the United Arab Emirates, dealers are asking around $115, and in China, the physical price has crossed $110. This is not a small discrepancy or a normal market spread. It is a massive $50 gap between paper prices in New York and physical prices in Asia. This gap represents a fracture, evidence that the global financial system is splitting apart. This investigation does not rely on predictions or speculation about future prices. Instead, it focuses on hard data coming in from around the world as of Friday, January the 2nd. Verified reports from Japan show 1-ounce silver coins selling for approximately 19,911 yen on platforms like Mercari Japan and through local bullion dealers in Tokyo's Ginza district. At current exchange rates, that amount converts to roughly $130 per ounce, confirming that these prices are real and not exaggerated rumors. Japan's surge in silver prices is driven by fear, not speculation. The Japanese yen is rapidly losing value. Japan's debt to GDP ratio exceeds 260%, and the central bank has effectively lost control of the bond market. As purchasing power collapses, ordinary citizens are rushing to protect their savings. They are not buying dollars or financial products, they are buying hard assets. When an entire population tries to move into physical silver at once, the price disconnects completely from global paper markets. In this environment, the paper price set in New York means nothing to a Japanese worker trying to preserve lifetime savings. Paying $130 for silver feels rational when the alternative is holding a currency that could continue to lose value. Japan is not an isolated case. It is a warning. The premium seen there is a fear premium, and at the moment, fear itself is trading at roughly $50 per ounce. Many believe the situation in the United States is still normal, but the data says otherwise. Although spot silver is officially priced at $73.14, major US dealers like COMEX are selling 100-ounce bars for over $80 per ounce. Large bars usually carry minimal premiums, often just cents above spot, yet today even wholesale industrial bars are selling at nearly a 10% markup. Silver coins such as eagles are marked up closer to 20%. This proves one critical point. Silver cannot actually be purchased at the paper price. Even the largest dealers cannot source metal cheaply enough to sell it at 73s. The real physical floor of the US silver market is already around $80. Paper contracts trade at a discount because they are unbacked. But the moment physical delivery is demanded, the price snaps back to reality. What exists now is a three-tiered market. The first tier is the paper fantasy at 73. The second is the US physical reality at 80. The third is the Asian panic price near 130. As you move east, prices rise sharply, revealing a broken arbitrage system. In a healthy market, traders would buy silver where it's cheap and sell it where it's expensive, closing the gap. That isn't happening anymore. The reason is structural. Export restrictions, particularly new licensing systems in China, have effectively locked down a large portion of the world's refined silver supply. What the West sees as a temporary anomaly, the East recognizes as a resource lockdown. This same pattern is visible in the Middle East, especially in Dubai and the UAE, where physical silver kilos are trading at prices implying $110 to $115 per ounce. Dubai, a global hub for physical metal trading, is acting like a vacuum cleaner for silver. Wealthy investors in the region are dumping dollars and euros, worried about sanctions and currency risk, and moving into tangible assets. They do not trust paper contracts. They trust metal in hand. The silver market has split into two worlds, paper and physical. The widening gap between them is not just a pricing issue. It represents one of the largest wealth transfers of the modern era. This is the Tokyo shock, and it is a signal of what happens when confidence in paper systems finally breaks. Investors in the Middle East are increasingly worried about the weaponization of the SWIFT system, which is why they are moving into assets with no counterparty risk. Silver has become one of those assets, but the question remains, why is silver trading near $115 in places like Dubai? The answer lies in a sudden breakdown in supply from Europe. Swiss refiners, who traditionally ship large volumes of silver to Dubai, are now diverting most of their output to China and India to capture much higher Asian premiums. As a result, Dubai is being bypassed, forcing local souk dealers to raise their bids. At anything below $115, the metal simply flows east to Shanghai. This pricing confirms a critical reality. In a truly free physical market, unburdened by paper short positions, the clearing price of silver is already well into triple digits. Any price below $100 represents a paper discount, not real value. South Korea provides further confirmation, with street-level prices approaching $97 per ounce. Korea is not merely an investment market, it is a global industrial powerhouse. Companies such as Samsung, LG, and SK Hynix rely on silver to manufacture batteries, semiconductors, and display technology. The fact that silver is trading near $97 in Korea shows that industrial panic has already begun. These companies are not waiting for the COMEX paper price to stabilize. Instead, they are purchasing directly from local refiners at premiums exceeding $25 over New York prices just to keep production lines operating. This is replacement cost pricing. When the absence of silver could result in billions of dollars in lost output, paying $97 per ounce becomes an easy decision. Industrial buyers are now setting the real price floor, and that floor is far above Wall Street levels. The root cause of this supply crunch is revealed in recent regulatory filings from Beijing. China has implemented a new export licensing system for strategic metals, allowing only 44 firms to export silver, each required to meet a minimum production threshold of 80 tons. This effectively excludes small and mid-sized refiners that previously supplied the global market, forcing them to sell only within China. In practical terms, this policy locks down roughly 60% of China's refined silver supply. This is a soft embargo. China has not announced an outright ban that would provoke diplomatic backlash. Instead, it has erected a bureaucratic wall that keeps silver inside its borders. This explains why inventories in Shanghai are rising while inventories in London continue to fall. China is quietly building a strategic silver reserve. Even Elon Musk has warned about this dynamic, recognizing that a Chinese lockdown of silver supply raises manufacturing costs in the United States while giving domestic Chinese producers a structural advantage. This is economic warfare disguised as administrative policy. Now compare global prices. The United States, at roughly $73 per ounce, is by far the cheapest silver market in the world. Japan is trading near $130, Dubai near $115, South Korea near $97, and China closer to $80. When a market becomes the cheapest source of a scarce asset, it gets strained. Traders are buying US futures, standing for delivery, and removing physical silver from the American system to ship it into higher-priced markets. This is a massive wealth outflow. US banks are holding prices down by suppressing the paper market, effectively selling strategic assets at a steep discount to the rest of the world. This behavior is not driven by strategy or generosity. It is driven by desperation. The banks cannot allow silver to rise to its true market value because they are trapped in enormous short positions. If silver were allowed to rise to $130, the resulting losses would exceed their capital reserves and push them into immediate insolvency. This is no longer a normal trade. It is a hostage situation. For decades, bullion banks acted as market makers, taking the short side of futures contracts. As demand surged, they went beyond hedging and began selling paper silver without securing physical metal, naked shorts. At low prices, this risk was manageable. At $70, it became painful. At $130, it becomes fatal. A $60 price increase on a 500 million ounce short position translates into roughly $30 billion in losses, directly threatening Tier 1 capital levels. That is why silver prices remain suppressed on the COMEX. The banks are not manipulating prices to make money. They are doing it to survive. If the paper market breaks and prices converge with physical reality, regulatory intervention would be inevitable. The bullion banks understand this, and they are fighting for survival. This situation has become an existential issue for the banks. What it creates is a solvency ceiling, a specific price level at which the banks collapse. While no one knows the exact number, market behavior strongly suggests it lies somewhere between $80 and $90. Every time silver approaches $80, a massive sell wall suddenly appears. That is not profit-taking, it is a defensive line. Banks are flooding the market with paper contracts to stop the price from crossing the level that would destroy them. But this defense comes at a cost. Every paper contract sold to suppress the price increases the bank's short exposure. To keep the structure standing, they are digging the hole deeper. In 1980, the Hunt brothers attempted to corner the silver market by buying. In contrast, today's banks have cornered themselves by selling. They are trapped. They cannot cover their shorts because buying would send prices exploding toward $130. They cannot simply hold either because physical metal is steadily leaving the system. Their only option is to double down, and doubling down always ends in failure. This suppression triggers a classic economic effect known as Gresham's law. Bad money drives out good money. In this case, cheap paper silver is driving physical silver out of the system. Banks flood the market with underpriced paper contracts at $73, and rational investors exploit that discount. They buy paper, stand for delivery, take the metal, and ship it to Tokyo or Shanghai, where it is worth far more. Ironically, the suppression strategy accelerates the very collapse it is meant to prevent by incentivizing the world to drain the vaults. We are witnessing the largest vault drain in history. Registered inventories at COMEX have fallen roughly 70% since 2020 and are now critically low. When inventories reach zero, the paper price becomes meaningless. Contracts can claim silver is worth $70, but without metal to deliver, the market stops caring. At that point, pricing shifts entirely to the physical market, and that price is set in places like Tokyo, not New York. So how does this end? If banks cannot survive at the real price, they will not pay it. Instead, they will change the rules. This is what we call the force majeure scenario. The most likely outcome is that physical vaults run dry, COMEX fails to deliver, and prices begin racing toward $100. In response, exchanges declare an emergency, halt trading, and force all open contracts to settle in cash at a fixed price, perhaps $80. Investors receive fiat currency instead of metal, while physical silver on the street surges to $200. This is the rug pull. The paper market saves itself by sacrificing paper holders. That is why the message is simple. If you don't hold it, you don't own it. Unallocated accounts and futures contracts make you a creditor to an insolvent system, and creditors are always paid last. The banks are trapped, the vaults are draining, and the paper market is a ticking time bomb. Yet many ask why arbitrage hasn't already closed the price gap. The answer is friction. Logistics, insurance costs, export controls, and vault bottlenecks are slowing the flow of metal. The price is rising, but it is constrained by physical limitations. Silver cannot be moved like digital money. It is heavy, bulky, and slow to transport. Moving billions of dollars worth requires armored trucks, certified cargo aircraft, and secure vault access. In reality, secure air freight capacity is maxed out. Logistics providers are booked weeks in advance. There are only so many planes and armored trucks approved for bullion transport, and nearly all of them are already moving metal east. This creates a speed limit on arbitrage. Traders see the opportunity, but the metal simply cannot move fast enough to close the gap. Insurance further worsens the problem. War risk premiums have exploded due to geopolitical instability, conflict zones, closed airspace, and shipping disruptions. These costs eat into arbitrage profits and force Asian prices higher to compensate. Geopolitical risk has effectively become a tax on physical metal movement, isolating markets into separate pricing zones. The final bottleneck is the vault system itself. Traders report growing delays when converting unallocated silver into allocated bars. What once took 48 hours now takes weeks. That delay exists because much of the metal was never physically there to begin with. It may be leased, rehypothecated, or only represented digitally. When delivery is demanded, banks must scramble to source real bars, transport them, and assign ownership. These delays are a form of soft default, not an outright refusal, but a system under strain. The suppression holds only until the last bar leaves the vault. When the bottlenecks finally clear, the price adjustment will not be gradual, it will be vertical. In a true squeeze, waiting is fatal. Every day you wait, the price in Shanghai moves higher, $100, then $110, and the opportunity cost bleeds you dry. This bureaucratic friction is not accidental. It is a deliberate tactic designed to slow the drain. Speed bumps are being placed in front of the exit, but friction only delays the inevitable. When the metal finally arrives and logistics clear, the result is a violent snap-up. Think of the market like a stretched rubber band. China's physical price pulls in one direction, while New York's paper price is artificially pinned in place. The tension builds. Eventually, the friction breaks. Arbitrageurs find new routes, or the banks run out of excuses, and the prices slam together. China does not collapse to $73. That's where the demand is. New York snaps upward, often in a single session. One morning, the market wakes up and the spot price has instantly adjusted to the street price. The premium vanishes because the spot price itself becomes the premium. This moment is the reunification of the markets. It will be violent. It will wipe out every short seller who bet that the spread would close the other way. And it will prove a fundamental truth. The paper market ultimately answers to the physical market. Right now, arbitrage is broken, logistics are jammed, insurance costs are exploding, and the system is holding together by a thread. The only real question left is positioning. In the final phase of this investigation, the endgame becomes clear. The $130 price in Tokyo is not an anomaly. It is a preview. The West is about to learn the difference between price and value. We have traveled from the street markets of Tokyo, where silver trades at $130, to the gold souks of Dubai at $115, to the bonded warehouses of Shanghai near $80, and finally to the COMEX floor in New York, where screens still flash $73. For the first time in modern financial history, a single global price no longer exists. There is an Eastern price based on physical reality and a Western price based on paper illusion. This fracture creates a rare opportunity. In the West, silver mining stocks are still priced as if silver were $30. Wall Street algorithms value miners based solely on COMEX spot prices. They do not see Tokyo. They do not see Dubai. They do not see the physical premiums. This blind spot has created a massive valuation gap. Many miners are already selling their silver into higher-priced physical markets, capturing real-world prices, while their stock prices remain trapped in the paper world. When earnings are reported and miners disclose record cash flows, selling silver at $85 instead of $73, those algorithms will be forced to reprice the entire sector almost overnight. This is the opportunity. High-quality primary silver miners are effectively silver bought at a discount on top of a discount, the paper price discount layered with an equity risk discount. It is leverage stacked on leverage. If New York reprices toward $100, miner cash flows don't merely double, they can triple or quadruple. This is torque, and right now silver miners offer more torque than almost any asset in the financial system. There is, however, one final and urgent warning. If you hold silver in an unallocated account or in a pooled program at a bank or dealer, you are in the blast zone. When the snapback happens, when New York gaps from $73 to $100, the institutions that owe you silver face a choice. They can either buy metal at the new higher price and deliver it to you, or they can invoke force majeure and settle your position in cash at the old price. They will choose cash settlement every time. You will see dollars credited to your account while silver trades far beyond your reach. You wanted metal, but you are handed depreciating currency instead. You are effectively cashed out of generational wealth at the worst possible moment. That is why allocation matters. If you don't hold it, you don't own it. In a system this fragile, only allocated or physical metal survives the snapback. The arbitrage is broken. The system is failing. But for those positioned correctly, the opportunity is just beginning.